Welcome from the sidelines of the New York Stock Exchange. I'm Jarrett Banks, editor at CorpGov and IPO Edge. Joining me is Keith Rosenblum, a highly successful constructivist investor and managing partner at Cruiser Capital. Keith, welcome to the program.
Hey, good to see you.
Good to see you. Let's start off high level. Is this a stock picker's market?
I think this is the definition of a stock picker's market, right? You have factors flying all over the place. You have a Russell 2000, the small caps, that have massively underperformed the large cap index. And if you take the equal weighted returns for the S&P 500 on a weighted stock, weighted basis, it was 7.5 for the first quarter. You take the equal weighted S&P 500, it was under 2. Just think about that for a second.
Right.
So everything is trading on factors, babies are being thrown out with the bathwater, so to speak, and other things are being lifted that maybe shouldn't be. So I think this is actually the definition of a stock picker's market, and it gets us pretty excited.
Okay, so you talked about the return disparity between small caps and large, and the all cap index and weighted. Let's drill down into that a little bit.
Okay.
What can you tell us?
Well, I think this speaks to the simple issue that the majority of publicly traded companies are small cap companies, right? Market cap's under, say, $5 billion. And the reality is that the liquidity, let's look behind us, in most of those companies isn't as great as it is in the larger cap companies. So what happens? They get less coverage, they get less inclusion in indices, there's less price discovery. And when you start to go down that path, under 3 billion, under 2 billion, under $1 billion, okay, under $800 million, price discovery is highly limited. And therefore, I think you're in a market where A, you can pick up bargains, B, you can probably short stuff that is irrational, but most importantly, I think that the people who run those small cap companies, as they think about how they create long-term shareholder value, have to be considering the M&A route. Because when you're that small and you don't have price discovery, you still have all of these costs, these fixed, finite, endemic costs of being public, period. And I don't know if you're aware, but the SPACs have had a little bit of a problem.
Right.
Yep. So you see what the D&O insurance is on microcap companies now and small cap companies. It's a crazy number. It's a crazy number. We were talking about this the other day with a guy, and he thought that the premium that I was referencing was the policy amount. And I said, no, that's the annual premium. So, it is incumbent on the people who are running these businesses to really think about how you're going to grow, how you're going to create value, how you're going to create really terrific working conditions for the people that work there, how you're going to create wealth for them, how you're going to create safe products and better products for your customers. There's lots to be thinking about, and the fact that you have limited liquidity, limited price discovery, and high fixed costs just really raises the bar for a lot of these smaller companies.
Okay, let's talk about why capital allocation and balance sheets matter so much right now.
You mean more than they normally do? I mean, come on. I think balance sheets are really important, but at the end of the day, right, as we all know, we have interest rates are much higher than where they were 12 months ago, even 5 months ago. I think we're going to stay higher at these rates. So I don't know if SOFR is going to be 5 or 4.75 or 4.5, who knows? But they aren't zero, okay? And as any living, breathing enterprise has, your cost of capital is SOFR plus, right? You can argue about what the plus is supposed to be, but it's a plus. So the cost of capital is higher. As Buffett always used to say, the tide has gone out. It's out there. Who's wearing the bathing suits? Because if you levered up before and you bought things that either you couldn't integrate or you haven't integrated, you're in trouble. You're in trouble. As you have to refinance, whatever source of capital you used to buy it, that's going to cost a lot more. And then towards the second part of that question, I'm just going to keep talking. Toward the second part of the question about why balance sheets matter, if you have a pristine balance sheet now, you're kind of in the driver's seat. If you're a public company, and go back to that issue before about microcap companies or companies under 3 billion, let's say, you have your public currency, and let's say you have a great balance sheet, you should be able to dictate terms in ways that others can't. Because you can offer liquidity, and you can offer, access to capital, which people who levered up inappropriately or levered up and haven't been able to integrate appropriately aren't able to do. So I think more than in the whole framework of stock pickers market, I think balance sheets really matter.
And are you seeing companies that have more aggressive balance sheets being punished by investors?
Oh, I think so. I think so. Look, the last month in the public markets have been a little confusing because as all this money has flown after the biggest cap stocks, the three biggest, right, are responsible for 25% of the move. Anyone in that QQQ framework has gotten a lift, but when you go to middle American companies, and that's a terrible thing to say because manufacturers are all over the place, but you know what I mean. When you look at standard industrial businesses, manufacturers or industrial servicers, they haven't participated as much. And I think that's where the opportunities lie.
All right. Now, you spoke at our conference previously
I
this
did?
year in Palm Beach.
I did, yes.
And you said a lot about the G in ESG, but is it safe to say that governance is back in the center?
Yeah, I think so. I think I've said this before publicly, so I'll say it again. I think that the E and the S in ESG are now table stakes, okay? If you're a company that produces anything of consequence, where you have an impact on the environment in some way, okay? And you don't have a philosophy or a statement of how what you're doing is improving the E, then you've missed the boat. And ultimately, you're going to be punished for that. But from my perspective, because it's table stakes, it's all G, it's all governance. What are the people who are entrusted with governing the company doing about those things?
Right. All right. And are you seeing activists pushing for more M&A transactions?
I think so. Here's what I think. Because the cost of capital has risen, because the debt markets, particularly right now, are really challenged, it's making buyouts more difficult. And so in this quest for growth, and this quest for, particularly in those mid to small cap companies where, again, you have to be able to rationalize those costs, scale matters, right? Scale matters. So mergers, trading paper for paper, is a pretty elegant way to move the ball forward, right? If you have two companies that are underappreciated, maybe it's easier to trade your paper, as if you've had two that were overappreciated, right? At the end of the day, where it comes down to, the decision should come down to, is how you're creating the best value for your stakeholders. So I think M&A is going to be very interesting. The want ads are filled with bankers who are distressed bankers.
Right.
Well, there's a reason for that. And what's your out? What's your exit there? And M&A is often your easiest and most elegant way to get out.
All right. Last question. What are some things that investors should really pay attention to for the rest of the year? Are there anything that sticks out in your mind that investors should really focus on?
Well, listen, I personally believe, and it's a good thing, that wage inflation is here to stay. So when you talk about the causes of inflation writ large, right, the elephant in the room has been wage inflation. Everyone's talking about all the commodity stuff, which is real, don't get me wrong, but commodities are by definition commodities. And then there's the whole argument about, well, rents, and this is the way rents should be factored in. Okay. The real issue that every single company in America is facing is that you have wages rising. Once you give somebody a raise, you can't take it back, right? That's not the way. It's not the way the human psyche works, and it's not the way we work. So wage inflation is here to stay, and what that means is you have to look at other elements of variable cost to improve operating margin. And that's where the rubber meets the road, I think, with really effective management teams, as well as good product. How are you able to do that? And one thing that I think you are going to see is you've seen a lot of people try to pass through price. I think a lot of that stays. And we'll see winners and losers.
All right, we'll leave it there. This has been Keith Rosenblum, Managing Partner at Cruiser Capital. I'm Jarrett Banks, signing off from the New York Stock Exchange.